19.7, which really wasn't.
Yes.
We are in a war. Maybe the United States isn't, but there is a war going on. So,
yes.
That should make everyone feel very uneasy.
Yeah.
We have significant inflation, and
yes.
we are looking at many of the tailwinds that drove the economy, from stimulus, delaying paying student loan debt, having child care tax credits, and of course, unemployment excess benefits. All of that was tailwinds as that is evaporating, it really arguably becomes headwinds. As it relates to residential real estate, I think that I don't see a correction coming near term. And I think that the moderation is what I would call it, because thinking about where we didn't expect and where we've gotten it wrong is that as the primary buyer is so challenged to find a home, they want to buy homes. They're certainly, we're seeing pent-up demand unleashed, and we see that reflected in the number of young adults, the 20 to 39-year-olds that are leaving home. And that number just, not shockingly, went up, call it from the end of 2000, or let me think, from 1990 to 2000, it was 16.4%, which is kind of like a normal number, 20 to 39-year-olds living at home. Yeah. And at the end of 2010, it shot up to 19.7, which really wasn't surprising, because we were in the middle of a great financial crisis and all these young adults were back at home. And we called it the coiled spring, that we would see all those young adults leave once they were gainfully employed. And it's hard to date. Imagine living in your parents' house or basement. So I think that the reality is that number we expected by the end of 2020 would normalize. Unfortunately, it didn't normalize. It went up even further, and it went up another, call it 100 basis points. We were puzzled by it, and we can go through a lot of reasons where maybe the stigma is not so bad anymore, living multi-generational, maybe it's affordability. The data is telling us one thing, and we're just not, confident. We really appreciate if this is a secular change. Certainly people getting married later, but the good news is COVID started unleashing some of that, and we started seeing that we were seeing decoupling. The numbers are still above where 19 were, and they were elevated from the end of 10. So the reason I give you all that is to recognize that millennials are buying. And at the end of really 16 was the inflection point for home ownership rate. So people think about, millennials are now buying. They've been buying for the last 5 years. Arguably, that's been the whole trajectory of the growth off the bottom, was really millennials stepping up and time to get more shelter with their families growing. Now what we've seen happen is that the primary buyer is, whether they can't afford it, which it's definitely potentially the case, or secondly, they just can't compete with cash buyers. So starting at the second half of 21, we really started seeing which was a lull in the market started evolving relative to the strength we had seen in 20, in the back half of 20, first half of 21. Summer, started hearing more builders saying, things were removing our sales caps. We're seeing homes on the existing market maybe sit a little bit longer. Something feels like it's changing. Mm-hmm. And then as rates started moving higher, we actually, this was in advance of rates moving higher, we started seeing sequentially in the second half acceleration greater than the typically seasonal slowing. Normally, sequentially, you see slowing. So we were doing better than historical seasonality. And I think what we explained that in the second half of 21 is what we really saw was a shift in investor sentiment.
Yes.
Investor sentiment above and beyond second home. Private investors, I'm sorry, go ahead.
I want to unpack all of that. And for the listener, Ivy, this could be the first interview I've ever done where I didn't say, let me tell you who we're listening to, right? But you're such a legend, and you've been so kind to be on my show multiple times. I actually want to unpack each one of these, because you're the one guest I know if I can just say one thing, and you're going to share brilliance, but I want the listener to unpack one at a time. So let's go to interest rates first. The Fed told us that they were going to raise the rates 3 times this year, right? As of today, we talked about, the 10-year being at, 1.89. You got massive sell-offs in terms of the equity market. With all the possible uncertainty, or very real uncertainty, why are they raising the rates?
Well, inflation right now, according to CPI, running at 7%, and recognizing that, PCE, which is another measure that the Fed really focuses on, consumer expenditures, personal consumer expenditures running hot over 5%, with inflation only accelerating right now. We're seeing oil prices just hitting $115 a gallon. You really thinking about the risk if the Fed doesn't start to pull back on the liquidity they provided this market, it's going to hurt consumers significantly. It already is hurting consumers.
Yeah.
Think about discretionary and non-discretionary spending. We all have to pay our rent or mortgage and utilities, and all the costs of everything in our lives are rising faster than our wages.
Yeah.
And the wages there are upward pressure on wages, which helps a little bit, but really the Fed's rationale is not only late, but so necessary. Otherwise, we'll have, the continuation of our buying power is just going to be under tremendous pressure, and it's hurting the very, people that arguably the administration and the government should be helping, because the affluent,
right,
just they can get richer from it. So, if real estate has always been a hedge against inflation.
Yeah.
So if you own a portfolio of assets and home prices are rising at a very fast double-digit pace, you're the winner, and you can borrow against that. And you have a lot of equity, but it's really an incremental buyer if we're talking real estate. And as mortgage rates, we always focus on the 10-year, but you can't focus on the 10-year any longer.
Yeah. Tell us why. That's always been the sort of leading indicator of what's to come.
The leading indicator has been the 10-year. And, when you look at the 10-year versus the 30-year fixed mortgage rate spread,
right.
And that spread historically used to be anywhere, and I talk basis points, or 1.6, 1.7%, 160, 170 plus basis points. When forbearance was first announced, and the industry was really scared to death that they were going to get, massive advances, and people just morally taking on forbearance against better judgment. So spreads blew out to like over 3 points.
Yeah.
And then they've since come back, but the 10-year, it's not following its normal course, because as MBS, overall spreads and demand are being viewed differently from the investor. So if the Fed is no longer incrementally buying as many MBS, securities, there's less demand for it. So therefore, the investors want a higher return.
Yes.
So as you'll see demand weakening, assumingly supply might also weaken. In other words, originations are going to fall off because of refis going down. But I do think that right now the spreads are widening. It's closer to 200 today. So it's above its historic range. And the mortgage companies are kind of killing each other competitively, which for the consumer is good, because that means that they're not passing the full extent of the pressure on MBS price to the consumer, but they're giving some of it to them, because otherwise they can't write mortgages and make no money. They can't lose money on every mortgage. So there's a little disconnect from the typical 10 to 30s. It's really the primary secondary spread.
So if the conforming today is call it a 30-year conforming loan is under 4, you and I both know, just looking back over time, that's still a historically low rate. But when you're going from a 2.65, right, what feels like, less than a year ago, to 4, it feels like an enormous amount of money. And when you're talking about a first-time buyer, the incremental increase of either their payment and or their purchasing power going down feels like a lot. So if you could talk broadly to every real estate agent on the planet who has 5 buyers right now that are concerned about interest rates, or maybe they're not, but I think they are, what's the advice you say to that buyer about settling their mindset around, I should still buy a house, or maybe I should wait?
I always think about ownership in the perspective, you're better off than renting. And many cities that may be mathematically not the case, like New York City or let's say San Francisco, but in most cities in the United States, you are better off being a homeowner than a renter. And the real simple reason is you can lock in a 30-year fixed mortgage rate and have your what I call non-discretionary shelter capped. And you can also build equity. There are costs associated with property taxes and other costs above and beyond to maintain your home. Yeah. On the other hand, as a renter, every year it's a variable cost, and that could increase on you. And in an inflationary environment, rents are going to continue to rise. So that's the setup. Now you have to ask yourself, though, from a timing perspective, am I buying at the peak? Am I buying at a market level where prices could start to moderate, and therefore, sequentially, I may be buying right when I should arguably be on the sidelines? I think it's too difficult to time the market, and I don't see a massive correction, and we can talk about that. What I
Yeah.
would say is if you need a home and you're busting at the seams wherever you're living, whether it's another kid, you just guys, and everybody has an extra kid in their square footage and they need more space. Those are the life decisions that should be the catalyst to determine to buy today, not because, oh my God, am I going to lose money or make money? I think it's more about lifestyle, and that's how we've always presented it. So if you're not in a rush and the market feels frothy, which it does, I think that it'd be better to probably be patient and maybe sit on the sidelines as long as you're comfortable in your current space. So that's how I approach it.
So let's look at it from a different perspective. The second of the three I's is inventory. And you go back to 2004, 5, 6, right, where we had this massive number of new construction at all kinds of different price ranges. We made it easy for first-time buyers to come in. I was told we have an equal, or in some cases greater, number of new construction inventory currently in process that will be hitting this year, like another 1.5 million properties. Can you talk about that? Can you talk about what you're forecasting for regular everyday sellers putting their home on the market? What's going to happen? Because inventory is, I don't want to say it's an issue because we sold 6.5 million houses last year. We just don't have enough inventory for the right type of buyer today. Is that ever going to get fixed?
Well, right now the supply chain is broken, and to the extent that cycle times are extended with 2 months on average, takes longer to build a home. So right now the backlog of single family homes is at a 2006 record level, or not a record, but back to 2006 levels. It looks like a hockey stick. So we've got a tremendous amount of homes in backlog that will get delivered. Do they get delivered as fast as the consumer would like, as fast as the potential prospective buyer would like, because they're building spec as well as doing for sale? And that on the multifamily side, we've got a backlog that looks like a hockey stick as well. And that's coming in suburbia, very small amount of it being condo, but mostly within suburbia. There is urban as well. That's at a multi-decade high. So, I feel like the boy who cried wolf, or winter's coming. At some point the homes are going to come. But I think that where they're building, the predominant new construction is going to be on the called tertiary market, on the outer rings, because they can't come closer in, not because there's not land, but it's because it's so expensive and there's less land to build on. So for builders, they typically will drive out to, whatever tertiary hinterlands, where the cows don't want to live, and they'll start building. And in addition to the builders, we also have developer operators that are doing a build for rent strategy. So, we'll see as the supply, we're watching completions, which have been under pressure. And because we know the builders, what they're telling us, we're talking to 45% of the new home market through the public companies. And then we actually survey another 15 to 20%. So we have a pretty good read on what their at least expectations are, call it, for the next 3 months, next 9 months. And they're very confident that they're going to grow community count. Toll Brothers said we'll grow communities this year 10%. We have other builders growing 5%, others trying to grow 20%. So whether they can get those communities up and in the timely fashion that they expect is a lot to do with some of the challenges we're seeing not abating. So the good news is that even with those challenges, they plan on growing, and I think that will provide more supply to the market. Now, where and what price point? There's not places you can buy in the twos anymore. So if you find, there's really a rare part of the country now that is in the top, call it 40 MSAs, where you can find a brand new home in the twos, maybe high twos, in a rare community. You're in the threes, that's also getting harder and harder to find. So you're finding yourself in the fours. And I was on the phone with a builder in what's it called, Richmond, Virginia, that area, and they're a little bit more primary in that market than call it non-primary, military, and it's thinking of it starts with a V, Hampton Road. That area is in the fours, seeing a little bit of moderation, where you'd gone from selling and having to cap at 4 a month. Now they're not in some of their communities hitting that 4. So I talked to some brokers in areas like Houston, San Diego, Austin, seeing a little bit change, nothing that's concerning, but it's just on the margin, maybe home sitting a little bit longer, nothing, everything flying off the shelf. Counter that with, open houses that you have people, around the block, and
Right.
there's
Right.
multiple. So I'm not suggesting that the market everywhere is slowing, that you'd say, I'm really worried. But, the best way to cure inflation is just at some point keep raising prices, and at some point the consumer will push back. So,
Yes.
but the consumer is not the only buyer right now. That's the problem. I think you've got multiple buyers, and the primary buyers having that trouble competing.
So before we talk about the investors, because I'm seeing the same thing. You're obviously much closer than I am, but one of my clients has an account where he's buying 75 homes a month in Phoenix. He has it for I won't name the fund, but it's significant. And now he's getting two more, let's just call it MSAs, Denver, and I think the other one's going to be Dallas. And in each one of those marketplaces, they want to buy 75 houses a month. But we're going to get into that. But I want to stop first and say, what about the normal everyday homeowners? Are we still seeing migration patterns? What's causing that seller to sell today? I go back to like John Burns stuff around super seniors, or the move up, trade up, homeowner who wants to get to that next level in terms of housing. What are you seeing from a trend standpoint that my client should be paying attention to? Who's going to be selling next?
Well, I think that the boomers and Xers are taking advantage of lifestyle changes. And, as the boomers are reaching, arguably retirement age, and they're in the 60s, and they have tremendous equity, the pandemic has really fueled or created sort of a catalyst to maybe push them into a co-primary or dual property situation. And that's been migration in from the North and the Midwest to the South. A new thing, by the way. It's been going on for decades. If you went
Right.
back and just looked at the data that we have, that's 100% sample size from the decennial survey, just go back to 2010 and look at that data. The blue states are growing at best kind of low single digits, where the red states and, if you want to call it smile states, growing, double digits. So that divergence is not new. What's happened in the last 2 years with the pandemic is it just magnified it. And the biggest winners are no income tax states, whether Florida, Texas, clearly Nevada,
Tennessee. Yep.
Tennessee, and those are benefiting from a sharp increase in sort of the boomers taking advantage of an arbitrage. The arbitrage is, with rates that troughed at 2.65, could I sell my expensive Northeast house that now I can finally sell at a price, in the suburbs of New York that I was never going to see. Now I can get that price. I can go to the South anywhere, have a way better cost basis and lower taxes. So we're seeing that migration continuing. I think that there is some, signs of some places it's starting to cool, like in Utah, where it was on fire, and then
Right.
Boise. So I think that trend won't change. I think that the secular tailwind is, as we age and our boomers are just as big as our millennials. The difference between the boomers and the millennials is that the boomers increased from the generation prior before them by 53%. The millennials were a 14% increase for the generation before them. So they're both about the biggest size, but everything has to be rate of change. We can't ever look in absolutes.
Yeah.
As incremental boomers are aging, they're going to be contemplating selling their homes, downsizing, looking for dual properties, and the Xers are right there with them. But the size of the Xers, which I'm an Xer, you're an Xer, maybe I think you're an Xer.
Yeah.
So
51.
you're an Xer. So the Xers and the boomers combined have also accumulated a great amount of wealth, for those that are exposed, even if it's just through their 401k. We've had a 30-year tailwind of the stock market. So there is a lot lot of, and the boomers and the Xers are also helping their children, their millennial children, and they're giving them the down payment. I thought it was interesting. Redfin came out and said that 25% of the purchases, I believe in 21, were used from the stimulus checks that they were given. So young adults that would otherwise have not been able to buy got stimulus money, 25%. And then Redfin said 13% used their cryptocurrency gains to buy homes. So we have had maybe more incremental buying because people have been flush with cash. What I'd like to watch and try to appreciate is when that cash is diminished, whatever incrementally it's coming from,
right.
And that starts to become, as I said, it's not exactly a headwind, but when you reverse a tailwind or you eliminate it, it in essence is a headwind. And so we'll see where consumers come up with the down payments, which they were struggling with at least as a first-time buyer.
Sure.
I think that on the good news for the existing homeowner, once again, is they've had so much equity accumulation just in the last 2 years, and looking at the actual dollars, it's almost $4 trillion of incremental equity that's been realized. And so, will you unlock that equity by contemplating selling? Well, if it makes sense for you because you have a great arbitrage. Mm-hmm. So is everyone is a shuffleboard of the United States going to go berserk, and everyone's going to go from the north to the south, or the Midwest to the Southwest? I think that starts to moderate, because I think the people that can do that, for the most part, they'll still do it. So just the question is, will it sustain at these elevated levels, or just moderate back to where we were and what we were doing? So that's something I think about. I do think the first-time buyer is the loser in this, because, when you look at the rent inflation, it's so egregious. It's so egregious to the consumer. And the prospective buyer who would otherwise want to save is now going to be spending a lot more of their income on non-discretionary parts of what they have to spend, i.e. rent. So the primary buyer is the loser in all this, really. But
I was going back to inflation. It's like I wrote down the note is, we're at a 40-year high of inflation. How do you see this impacting the rental market broadly? And you're exactly right. People that are paying rent are, I think, in more trouble than the person that's trying to save money to buy their first house, and there's no inventory for them.
Well, I think what ultimately happens is that we'll force consolidation. We'll force consolidation of households, because people cannot continue to pay the rents, and everything else is going up in their lives. I mean, renewal rents, they have what's called loss to lease. I don't know if you've heard that terminology. So there's a gap between the renewal and where move-ins are. And people are getting notices to get them to mark to market, and they're forcing them to have to find alternative shelter. And that's like maybe more evident in the Class B product, but we're seeing stress in the market, and you're going to see evictions rise. You're going to see foreclosures increasing. You're going to see delinquencies rise. We're already seeing it. So what we all forget as a nation is that prior to COVID, housing was, just okay. Right. And it was really a tale of two markets. But now that we've had consumers struggling with down payments, consumers struggling with too much debt. And so that kind of all went away. And so that's why when you snap your fingers and 2 years later, what's really changed? Mortgage rates went down. Right. The government flushed the system with cash and liquidity and money, and gave you checks like from the sky. We were raining money. And what do people do? Well, I'm not going to pay my mortgage. I'm not going to pay my student loan debt. I can go buy a house. So take that out of the system, and what's left? We have a primary buyer who, by the way, at the end of 2020, in the fourth quarter, the number of renters converting to homeowners skyrocketed from quarter to quarter. We went from a trend line of, call it 2+ million, 2.3 million a year renters convert to owners. And it got to 2.85 million nearly in fourth quarter 20, which would look like a hockey stick. And then it stayed elevated for another quarter or two, and then is now back to like 2.45 million. So it's still trending above where I guess historical trend line would be. But that moderation in the renter converting to homeowner is either suggesting one of two things. They can't afford it anymore, or they're still buying. Obviously 2.4 is above the trend line, but it's not as robust, or they just can't compete with cash buyers, because in the cash market, year over year, 2-year stacked purchases, over 40% of purchases are made with cash. On an annualized basis, the NAR just reported 27% in the January closing data, whereas mortgages were down 13%. So your primary buyer is moderating in the face of acceleration in investors. And that's really the dynamic that we're faced. And even if the builders provide more shelter in the third ring of the market and they're bringing on, quote unquote, a first-time buyer product, you've got to, deal with what is now a much more significant level of inflation to buy that house today. And I do think that rates matter. I never think about absolute rates. I think that it's a rate of change. And what does it do to the monthly payment? So as of the fourth quarter of 21, with home prices up as much as they were and rates not even yet up, the monthly payment on average for a first-time buyer using FHA mortgage and assuming, none of the incremental costs of property tax, and we do incorporate insurance, homeowner insurance was running up year over year 17%. Right now, year to date, we're up more like 25%. So it does matter. But the good news for the consumer that can get a home, if we are actually going to remain in an inflationary environment, they can be a winner unless we start to see that the demand on the investor side really peters out for various reasons that we can speak to. But I'm an analyst that understands what the investor impact will be and how much of it's investors, and I can tell you more about the investors. I understand what the primary buyer is doing. What I never can get my arms around is what's going to turn the investor sentiment and when. And that's the only way we can, obviously think through the potential reasons, but to actually time that right one, it just is not something that I think that any of us truly understand, because the alternative investments in the world we live in right now are not compelling. And until they don't get their return, that's when they'll probably continue. It's only when they hit the wall. And when do they hit the wall is the question.
So I'm being mindful of your time, but I got 4 questions I got to ask. And we're touching on one, which I want just your insight on investors. You touched on migration patterns, and the note that I wrote behind it, you're talking about back since 2010, blue states versus red states, single digit versus double digit. My second question is, where do we get this information? If an agent's listening right now, or a team leader or a broker's listening right now, let's just start easy. What are the go-to sources to get the kind of information that they could be more educated to create better content, inform their buyers and sellers? Let's go info first.
Well, everything, you have to just go to zelmanassociates.com.
Thank you very much.
Read our newsletter and read our blogs. And if you want to purchase research, you can also do so. But, we rely on, our secret sauce is really more owners and operators. So we rely on C-suite executives, not public. We watch what they're saying, but we really are relying on the people with boots on the ground. And then we have that married with lots of data that's available, publicly available data. And we do have some proprietary data that we aggregate and have some AI and things that we are utilizing. So I would say it's a secret sauce that, unfortunately not everyone can replicate, but the government provides a tremendous amount of data that is accessible and is available to anyone. And looking at Census Bureau data, reading the decennial survey that came out, anyone can access that.
Yeah. So listen, everybody, I am a subscriber with Ivy Zelman, and first of all, just for your Saturday morning emails of whether it's, personal or fun or the team, but to be able to go deep on the daily, to know exactly what's going on from you and your analyst's perspective, for me there is no greater education. If you're in this space and you get paid in direct correlation to the value that you deliver the marketplace, the value we deliver today is certainty, and certainty comes from data points. Right? So hands down. So not even a shameless self-promotion. I'm telling them, sign up. Okay. The big question, we started with it in the beginning, was when I said to you, interest rates, inflation, inventory, and a war. Is a correction coming? Correction coming, Ivy? Tell us. What do we need to know?
There'll be parts of the markets that correct, and that's really contingent on when the supply hits. With the amount of supply we have in backlog, I'm not worried about a significant correction in the Midwest where there's very little new supply and backlog. I think there are parts of the country where supply is very constrained, and probably will have more weather the storm that might be brewing. You get into the Southwest, a market like Phoenix, even with the strength of the inbound migration, even with the strength of what is perceived to be the strongest job market, and Amazon's adding this and this one's adding there. I think that the reality is that we're building more than the incremental households there. So I think Phoenix would be a market that's ripe for correction. I think you could see in Austin, Texas markets, the Carolinas, where there's just tremendous amount of new construction. The sad news of the industry is like everyone's using the same data to determine where to go and expand and where to invest capital. Is it a shock that they're picking Austin or Phoenix or Boise? So at some point, because they don't talk to each other about it, they just go out and buy land, and developers are happy. They've got a lot of incremental buyers, but like land prices nationally are up nearly 40%.
Right.
And that's not even including like a Madison, Wisconsin, that's up 10. They look at Phoenix and Austin as example, they're up significantly more than that, 50, 75%. And so builders just have to drive further out. So they keep building more and more product. Right now, fortunately, they're able to sell what they've completed, but we just look at that inventory and backlog and think that that's where there'll be pressure. And then that circles back to ring 2 and ring 3 and ring 1, because if that market's cooling, I think that the iBuyers, if they were to step away, like in Phoenix, think about 20%. I think that's too high. I think it's more like 12% of the overall market.
When Zillow is buying Opendoor, OfferPad, Zillow's out. So
yeah, but there's enough that activity, we'll just say that matters, but it probably is more zip code dependent.
Yes.
But if they were, for whatever reason, liquidity such where they were to pull back, I think that would enable the primary buyer to come back in. And I do think that there's a lot of the iBuyers are selling direct to SFR.
Yeah.
And therefore the primary buyer doesn't really even get a look at it, because that's a really nice, easy channel for them to sell to. Not all of it, but I think there's markets that could correct, and I'd be more concerned about not looking for a GFC. There's just too much equity in the market for that.
Okay, so I want you to unpack. So when I say correction and you answer correction, that there's a really good chance the listener thinks 2007, 8, 9, 10.
Right. So I said no GFC. I mean, what got us into trouble with GFC was that it was all leverage.
Yep.
So I think that there's so much equity in the system, and that gives me the most conviction.
Right.
We'll definitely see foreclosures rising, but a lot of that will be negligible because there is so much equity and people can sell and consolidate households. But we will see that.
But if I can just say though, around foreclosures, correct me if I'm wrong, we've averaged 200,000 foreclosures a quarter in the U.S. for as long as we can remember. We just had the massive spike of 8, 9, 10 that threw everything all out of whack. And then because of the moratorium on payments and making it easier for people to stay inside their houses during COVID, right? All of a sudden you start reading headlines that say, foreclosures are up, 100%. So it went from 1 to 2, right? So when you say foreclosures, that's also going to scare people.
Yeah. Well, foreclosures is a natural part of what this country has on an annualized basis, unfortunately. Mm-hmm. Just like we have a natural level of eviction that didn't happen.
Right.
And so, maybe there will be an elevated level just because we were so below normal for a while. I'm not really concerned about it. What worries me is the appetite changes. So when I look at existing home sales in 2021, the entire increase of 9% was 100% explained by investors. And let's just say that as investors consist of true second homeowners, private investors that are looking for diversification from the stock market, that are going to rent them out and hopefully get cash flow annuity streams. You've got fix and flip buyers, you've got iBuyers, I call those the liquidity providers. Yeah. And certainly you've got SFR / institutional capital buying. So if you say, that asset class is in favor, and it's really a new, exciting asset class to many. In other words, it's been around single family rental for a long time, but a lot of the, last 2 years, it just became exponentially on fire. So is that asset class going to deliver the returns?
Right.
And you're going to see that therefore carry the market for the next 5 years in an inflationary environment and keep the market tight and keep HPA rising? Or does the bloom come off the rose because a lot of their expectations or occupancy is running at 98%, I've got double-digit rent growth, and now all of a sudden what I bought, I paid up for the next house, I'm not getting those rents anymore.
Yeah.
Consumers going, I can't afford it. There's not enough bodies because there's more supply. So those are the things that we'll be watching. But to me, it's not the GFC because of the amount of equity, but I do worry that these investors at some point don't either, whether they don't hit their return metrics or they lose their appetite and resi does no longer isn't the prettiest girl at the dance and something changes. Maybe that, inflation is going to guard against that because it's a great place the world views to hedge themselves. And, is it all bad that we have this many investors? I mean, the Canadian market is laden with investors and it's just been on fire for decades, with investors being the primary driver of that growth. So I just think what was disappointing is the fact that the primary buyer is really the loser in this.
Yeah.
So for realtors, I guess work with investors. There's lots of investors that would like to buy homes to create this annuity stream to give them, diversification.
So last question, then I'll let you go. And I'm always so grateful for the time. Like, thank you so much. I'm the interviewer and I have 3 pages of notes already. So the typical Tom Ferry podcast, I'm taking notes like crazy. So the last question is, when we chatted last, we were talking about, call it roughly 138 million homes in America. We know that approximately 40% of them have no mortgage. Of the remaining balance, it was half had an interest rate lower than 3.5, and the balance had an interest rate higher than 3.5. My question for you is, if I'm a smart agent today and I'm marketing, should I be marketing to the people more that have that interest rate that is, 3.6 today, 3.7, that they just never refied? Mm-hmm. Or should I be just marketing to everybody to find out who wants to unlock their inventory?
Well, I think,
or not inventory, excuse me, who wants to unlock their equity?
Well, I certainly think you have to always be marketing to prospective sellers. And right now it's a great time to sell. It's an incredible time to sell. And the numbers, just to give you some perspective, roughly 70% of homeowners in the United States are locked in below 4%. And that number, obviously, for comparative purposes, at the end of 18 was 39%. So we've had a massive refi boom that has unlocked tremendous wealth for people that have taken advantage of that significant drop. So if I'm sitting here and I'm thinking, it's such a hot market, my house has doubled in the last 2 years. Oh my God, I don't know what I'm going to do. I think that it's so much more expensive to go buy another house. But you can convince a prospective seller that, you can probably keep your payment the same, but if you take that equity out and you are able to move to a market where it's a more affordable, that's the opportunity right now. Is the arbitrage still exists if someone has the wealth and the wherewithal and are thinking about that demographic of the Xer and Boomer, that maybe I don't want to be freezing my butt off anymore in, Pennsylvania or New York. And I'm thinking about it. And if you can kind of hit them where it's time to do it now, because the market can't sustain the level of appreciation, because we're going to hit really some affordability pressures, I would definitely be marketing to that group. But keep in mind, the closer we get to a mortgage rate that makes that a disincentive, like if mortgage rates would go to 4.25, we thought 4% for sure would slow the market down, because 70% are below that. And it's not right now. And I think it's more, again, because of the incremental cloudiness and the investors that are really fueling the growth. But I do think that the higher the rate environment, gets, the more challenged and disincentivized those homeowners will say, you know what, I'm good. I'm locked in at 3. I'm not giving up this low rate unless I'm going to go to Nashville and live where my grandchildren are, and I can find something and it's still a good arbitrage. But those will start to moderate because people will start to get nervous. So we'll see. Hopefully rates don't go up much more than where they are right now.
At what point, I know I said to you last question and I'm asking another question, I can't help it. At what interest rate percentage do you think it makes everybody pause? Is it 5? Is it 5.5? Or is it 4.25 like you just said?
I think rate of change again. If you call a bank, you'll get a different rate every bank you call. And so there's loan level pricing adjustments. There's, obviously dependent on FICO scores and debt service. I think just focus on the rate of change of the monthly payment. And we're up 25% right now, roughly. So if home prices go up another 10% and interest rates continue to march higher, I think that the combination and the rate of change will start to impact, if you arbitrarily pick a number, I mean, 5%, I think you'd have pretty much everyone other than those that live under a rock and have really bad credit that have already refied and are at lower levels. I think my view is the market is really going to be challenged at a 5% mortgage rate, but I think it could get more challenging just even going up 4.25, 4.5 for the primary buyer again, not that investor, because the investor is going, oh, I got 10% inflation. Yeah, so what if I've got to pay an X more dollars? I'm going to get a better return in the long run if I lever it up. Love it.
So Ivy, what's been so great is I'm looking at the two, like the Gen Wires that are sitting behind me that are actually, doing all the recording here and social. And I've been telling them for the last, how many months now? Buy a damn house. So I think you guys just got it from the Oracle. So she's the Wizard of Oz, the real deal.
Only if they need to, though. Don't do it as speculation.
Oh, no. No, we're way beyond that. Like I care too much about these two. It's like, no, buy this forever house, or better yet, do a hack house, right? And get three of your buddies to pay your mortgage. All right. So Ivy Zelman from Zelman and Associates, ladies and gentlemen, you should listen to this at least 10 times. And then you might want to send this to 5, 8, 10 clients that are on the fence and nervous, because you're hearing from someone that has much broader perspective and can work through all the noise and get to the truth. So Ivy, you're a blessing. I totally appreciate you. I'll let you run. Thank you again so much. And I look forward to seeing you soon.
Take care. Thank you.
All right. Take care, everybody.